The US Federal Reserve has cut interest rates by half a percentage point overnight, putting pressure on the Reserve Bank in Australia to bring forward its own rate cuts. Joining me now on this, for more on this, Barrenjoey Chief Economist Joe Masters. Thank you for your time. Look, it's one of the factors, I suppose, the money rates around the world. What did you make of this? It was bigger than expected. I guess the ramifications for the global economy in Australia as well.
Well, as you said, it was somewhat of a surprise. A rate cut was widely expected, but not to be 50 basis points. And we've seen a number of central banks kick off their rate cutting cycles with more modest 25 basis point cuts. So why did the Fed do this? Well, it's not actually that they're panicking about recession or panicking about the economy. It's more to do with the fact that the risks are shifting and they're a long way from what we call a neutral policy setting. So that means that if they do need to protect the labour market, they need to get rates down a bit faster, and they wanted to take a slightly bigger first step to mitigate some of that risk.
So how do you read it when people sort of go, OK, compare banks and their performance? Because some people are saying this is what happens when you hike harder, which the US did. You get inflation under control and then you can have cuts earlier. Albeit, it's worth noting, inflation was earlier on in the US, but the flip side is our jobs market is still really strong. So we didn't hike as much, but our jobs market's been protected. How do you compare and contrast the two, I suppose, approaches of the Reserve Banks?
There's undoubtedly some global commonality to the inflation shock that many economies have suffered. But what we've got now is the persistence in inflation's really related to domestic economic settings. So as you alluded to, our labour market remains much stronger, even stronger than that in the US, where their economy is a lot stronger, but their labour market is easing. We just got jobs data today, and we're still seeing really quite strong employment growth. The unemployment rate's lifted off its lows, but it's not rising rapidly. And in fact, today it was stable at 4.2%. So that's the first factor. Our economic cycle is a bit behind the US. As you said, inflation rose a little bit later. It's coming down a bit slower. And also, as you said, we didn't hike rates as much. So there's a couple of things there to highlight. The first one is that different central banks do have slightly different inflation objectives. Here in Australia, we target 2 to 3% on average and an aim for the midpoint of that. The US target is a very clear 2%. And in fact, that's probably more globally common. So that's important to remember. And our central bank chose a very different path, a different set of trade-offs. As you said, we didn't hike as far, which means we take longer to bring inflation down, and it means rate cuts are further away, but we've experienced less pain in the near term.
Yeah, and the jobs market, as you say, staying strong despite how much population's increasing. So even though it's steady that the jobs growth is going on, even there's a caveat because there's more part-time this month in particular. This is the final one. So arrears, default in the Australian market, a mortgage default is quite rare. You can even access your super. So maybe it's not the best measure. It's very different to the rest of the world. But arrears is an interesting one. That went up considerably from sort of 0.5% to 1.5%. But that in itself is an historical average. So is this the fact that mortgage holders are withstanding these rate hikes really well, or have they now used up their buffer and we could see this number really go up significantly?
I think the rise in arrears is telling us that monetary policy is doing what it's designed to do, that some households are starting to struggle to make ends meet. Now, for some time, they might have had a stock of savings from the pandemic, but also the labour market and the ability to work lots of extra hours has been helping households. Now we're in a situation where I guess the rubber's hitting the road a little bit and we are seeing a little bit more stress come through. As you said, though, arrears are only really back to their long-term historical average. And we do think that rate cuts are ahead of us. At Barrenjoey, we think the first rate cut will be in February. So we don't need households to hang on for too long. And the most important thing is that we're not seeing a material rise in layoffs. So as long as someone's got a job, the bank will work with them. They might go into arrears, but unlikely into default. So we're not seeing widespread financial distress.
Yeah, interest-only options for a few months, that sort of thing, as you say. Having a job, you can usually withstand it. All right, fascinating to get your insights. We will see. We think we're still on the path to cuts sooner rather than later, but time will tell.